Well, hello again. Welcome to the Playbook. Over the last 2 weeks, we've talked about why you should invest, and we've talked about the mathematics, compound interest, that makes investing powerful. But we haven't answered the most fundamental question: what are you actually buying? Section 1, the coffee shop. Imagine you own a coffee shop, not a chain, not a franchise, your own small coffee shop. You operate it yourself. You're there every morning at 5 a.m., preparing. You're there serving customers all day. You're there closing up at night. And every day, customers come in. They buy coffee. They buy pastries. They pay you money. At the end of the day, you count the register. You spent $200 on supplies, beans, milk, pastries, cups. You spent $300 on rent. You spent $100 on utilities and miscellaneous costs. Total expenses, $600. But you made $1,000 from customers, so your profit for that day is $400. Now, you own this business. This entire business is yours. The building isn't yours. You rent it. But the business itself, the operation, the customer relationships, the recipes, the brand, all of it is yours. Every single day, that coffee shop generates $400 in profit. That profit belongs to you. This is what owning a business is. Section 2, fractional ownership. Now, imagine you don't want to run the coffee shop yourself anymore. You're tired. You want to do other things, but you don't want to sell the entire thing. So you decide to divide the business into pieces. You divide it into 100 equal pieces, 100 shares. Each share represents 1% ownership of the coffee shop. Now you keep 70 shares for yourself. That means you still own 70% of the daily $400 profit. So you get $280 per day. You sell 30 shares to other people. They pay you $10,000 for those 30 shares. Now they own 30% of the business. This means that every day, those 30 shares earn 30% of the $400 profit. That's $120 per day. Each share is earning $1.20 per day. Over a year, each share earns approximately $438. This is what a stock is. It's not a lottery ticket. It's not a price chart. It's not something abstract. It's a fractional ownership claim on a real business that generates real profits every single day. Section 3, the reality check. Now here's where most people get confused. They look at the stock price of that coffee shop. Let's say each share is trading at $100. And they think, is that expensive? Is that cheap? But that's the wrong question. The right question is, does the business justify that price? If each share earns $438 per year and it's trading at $100, then you're paying roughly 23 times the annual earnings. This is called the P/E ratio, price to earnings. Is 23 times earnings expensive or cheap? Well, that depends. If the coffee shop is stable, if it's been generating the same profit for years and will continue to do so, then 23 times earnings is reasonable. But if the coffee shop is declining, if customers are disappearing, if competitors are opening nearby, then 23 times earnings is extremely expensive. You see, the stock price is just a number. It's what people are willing to pay. But the business is what it is. The business generates $400 in profit per day. That's a fact. That's not going to change based on what people are willing to pay for it. So when you buy a stock, you need to ask yourself, am I buying this at a price that justifies the profits it generates? Section 4, the critical distinction. Now here's the distinction that separates successful investors from unsuccessful ones. Most unsuccessful investors think about the stock price. They watch the chart. They see it go up. They think, this is going up, I should buy it. They see it go down. They think, this is going down, I should sell it. This is backwards. The stock price is constantly changing. Hundreds of thousands of people are buying and selling every second, pushing the price up and down based on their emotions, their news, their fears. But the business, the actual coffee shop, doesn't change as often. If the coffee shop generates $400 in daily profit, it generates $400 in daily profit. That doesn't change because someone is panicking and selling their shares. The price can drop from $100 per share to $50 per share, but the business still generates $438 per share annually. When this happens, the business is cheaper. The stock price dropped, but the underlying business is worth more relative to the price. This is when you should buy. Conversely, the price can rise from $100 to $200. The business still generates $438 per share annually. Now the business is more expensive. You're paying twice as much for the same earnings. This is when you should avoid buying, or potentially sell if you own it. Most investors do the opposite. They buy when the price is high and everyone is excited. They sell when the price is low and everyone is panicked. This is why most investors lose money. Section 5. What determines business profit? Now, the coffee shop makes $400 per day, but why? What determines that number? Several things. First, how many customers come in? If 100 customers come in and each buys one coffee for $5, that's $500 in revenue. If only 50 customers come in, that's $250 in revenue. Second, what's the profit margin? If each coffee costs $2 to make and you sell it for $5, your margin is $3. If your costs rise to $3.50, your margin drops to $1.50. Third, how much does it cost to operate? Rent, utilities, salaries, cleaning, equipment. All of these factors determine whether the coffee shop generates $400 in daily profit or $100 or $1,000. And here's the key. When you buy a stock in that coffee shop, you're betting on these factors. You're betting that customers will keep coming. You're betting that profit margins will stay healthy. You're betting that operating costs won't explode. You're not betting on the stock price. You're betting on the business. Section 6. Real examples. Let me give you a real example. There was a company called Kodak. For decades, Kodak dominated photography. If you wanted film, you bought Kodak film. If you wanted a camera, you often bought a Kodak camera. Kodak was incredibly profitable. The business generated massive daily profits. And then something happened. Digital photography was invented, not by Kodak, by someone else. At first, Kodak didn't worry. They thought, digital cameras are a fad. People will always want film. But they were wrong. Within 20 years, nobody wanted film anymore. The profit that Kodak made every single day, it disappeared. The stock price collapsed, from over $90 per share to bankruptcy. Now, if you had bought Kodak stock thinking, I'm buying a stable photography business, you would have lost everything. Because you weren't buying a photography business. Digital photography destroyed that business. You were buying a business that was becoming obsolete, and you didn't realize it. The opposite happened with Microsoft. For decades, people thought Microsoft would be disrupted. They thought the Internet would destroy Microsoft. They thought smartphones would destroy Microsoft. But Microsoft adapted. The business didn't generate the same profits, but it kept generating profits. It evolved. So if you had bought Microsoft stock thinking, I'm buying a software monopoly, you would have been nervous many times. But if you had bought it thinking, I'm buying a business that adapts and survives, you would have made extraordinary returns. The business justified the price over the long term. Section 7. The owner mentality. Now here's something critical that most investors miss. When you buy a stock, you should think like an owner, not like a trader. If you owned the coffee shop outright, would you panic when a competitor opened next door? Would you sell the shop the moment that competitor appeared? Probably not. You'd watch. You'd see if your profits decline. You'd see if customers stick with you or leave. You'd think about the long term. You'd think about the fundamentals of the business. But when people buy stocks, they panic at every price move. The stock drops 10%. They panic. They sell. But they wouldn't sell their coffee shop because of a 10% price drop. A price drop doesn't mean the business changed. If you thought like a true owner, if you understood that you own a fractional share of a real business that generates real profits, you would ask different questions. Not, is the stock price going up or down? But, is the business generating more or less profit? Do more or fewer customers show up? Are profit margins expanding or contracting? These are the questions that matter. And when the price drops and the business is doing fine, a true owner thinks, the price is wrong. I should buy more, not sell. So let me be crystal clear about what you're buying. You are not buying a stock symbol. You are not buying a price chart. You are buying a fractional ownership stake in a real business. A business that either generates profits or it doesn't. Your job is not to guess what the price will do. Your job is to understand the business, to understand whether it will generate profits tomorrow, next year, and 10 years from now. If you can do that, if you can honestly assess whether the business will thrive or decline, then the price becomes almost irrelevant, because over time the price follows the profits. Next week we're going to talk about something that separates great businesses from ordinary ones. We're going to talk about the moat. Until then, remember, you own a business, not a stock. Invest accordingly.